Welcome back to Indianomics. Indian bond yields fell dramatically after the budget, but most of those gains, which were caused by the lower market borrowing program, were wiped out because of the higher than expected US yields due to higher inflation in the US. So how will Indian yields shape up in the coming months? Separately, the Indian rupee has been solidly ranged despite rising US yields and the occasional rise in equity outflows from India. Will the rupee appreciate this year thanks to bond index inclusion inflows? For all these questions, I'm joined by Sameer Goel, Global Head of EM and APAC Research at Deutsche Bank. Sameer, good morning and thank you very much indeed for joining us.
Morning, Lata.
Well, the first thing that's shocked the market lately has been the US PPI numbers and before that, the US CPI numbers. What's the expectation now? What is the rate cut pushed out to? And more importantly, what's your view on the US 10-year yield?
So, Lata, obviously the inflation numbers last week in the US, both the consumer price and the producer price numbers were higher than expected. And I think it's just not about the numbers being higher. I think they very seriously call into question the idea whether we have seen the best part of the disinflation process already over with the US and similar to the concerns with a lot of the Fed speakers have been voicing, is it that there is a big last mile issue on inflation in the US and how quickly they can get confident about being able to get to their target sustainably for inflation at around 2%. Now, I think in terms of numbers, what these prints from last week do is only marginally impacted our own forecast for core PCE in the US, probably being still at moving down to about 2.3% by the end of this year, and which should be largely in line with allowing the Fed to be able to start to cut rates by the middle of the year. But it does raise issues about whether and how quickly and how closely we need to watch the inflation trajectory in the US to be able to get the timing and the scale, the quantum of that easing through. The markets have already pulled back on their expectations of the Fed cuts pretty substantially. At the start of this year, we were pricing in close to about 150, 160 basis points of cuts for 24. We are now pricing in less than 90 basis points. So I think the market narrative has very clearly moved closer to the Fed in terms of its concerns about how sustainable this path of disinflation here is.
Okay, but for us in India, the more important point is the shadows cast by the 10-year bond yield on Indian bond yields. Now, what is your estimate? There is also this fiscal angle being an election year. We could see a repeat of the first quarter, the October, November, December fiscal deficit getting extrapolated, in which case the US fiscal deficit could even go to 8%. So do you think, therefore, that the bond yield doesn't fall much, the 10-year Treasury yield? What's the range you're looking at?
Yeah, so I think the Treasury yields do feel like they are fairly well supported here, and especially sort of north of 4%. I think there are several dynamics, of course, which go into Treasury yields. It's not just about the Fed view, it's also about the quarterly refunding announcements which have come out, which seem like the worst of the duration supply is kind of past us, but obviously concerns around elections and about what that could potentially mean for fiscal policy, though a lot of that is, I guess, more of 25 rather than an issue for 24 immediately. The Fed's also been expressing concerns around quantitative tightening and as to whether they will necessarily continue with that same pace. I think a lot of these dynamics come together to our mind to suggest that you will see a bit of a support here as far as Treasury yields are concerned. We still think the curve will bull steepen. Right now, you're seeing the 2-year, 10-year spread at being close to about minus 40. We think by the end of this year, we flip to about plus 40 basis points, but that's largely as the front end yields come down. I think the back end yields we feel around in the 420-25 region seem fairly well supported. There is even a risk that if the current sort of trend of good data continues in the US, that we actually see the yields move up a little bit further before, to our mind, settling by the end of the year at around this 415, 420 levels.
Oh, really? You expect it to go even higher. In that case, where does that leave, say, Indian bond yields? Your own report, I think my chat with you earlier, you had suggested that yields could come down because of the bond index inclusion. the Indian borrowing program is also lower than what the market was estimating. So what are your yield expectations on the Indian 10-year? And will that be spoilt by the US yields remaining very high?
So I think the US yields are a factor to the extent of determining, if you might, the timing of how quickly the yields can reprice, not just in India, but most of emerging markets. But I think ultimately the direction of travel is very clear. I think in the case of India in particular, we've always thought that the beta to US yields is relatively low compared with a lot of other emerging markets. India as an economy has proven to be a lot more insular to the volatility in the global economic and rate cycle. Like you said, the longer term narrative around bond index inclusion, the fact that we are well on the path for fiscal consolidation, and that's largely meant that the bond demand supply dynamics has become a lot more favorable towards for India into FY25. Obviously, our outlook on RBI, we still think the Reserve Bank will be in a place to potentially change its stance by April and maybe start cutting rates by June. We still think we'll probably get about 100 basis points of rate cuts in fiscal 25. I think a lot of that comes together for us to remain relatively fairly constructive on Indian bond yields. Our targets being, at least the first initial targets being to get to about 675. I think, again, the timing of that could be a little bit more predicated on when we actually see the rate cuts, when we see the flows relating to the index inclusion. But to us, there is still a good case to be long Indian fixed income.
That would be something of a historical new. The US yields being, the Indian yields being only about 200 basis points higher than the US. I mean, if what you say is 4.5 or 4.25 for US 10-year treasuries, then Indian 10-year at 6.75, it's kind of a historical low, right?
I think it's a structural re-rating. I mean, a little bit of this is about a bit of a mistiming in business cycle, where you're clearly seeing the US rate cycle being if you might, pushed out because of the path of disinflation. And like I said, the last mile problem, which India doesn't necessarily have. We think core inflation is going to average at 4%, maybe even slightly below in the next fiscal year. We think headline inflation is going to come in closer to RBI's target of 4.5%. Or what's projecting 4.5% for the next fiscal year, gives RBI that space. So some bit of this is about a business cycle and policy cycle mismatch. Some bit of this is also about a structural re-rating, where the Indian economy, with its much better growth and inflation mix, and how that allows the risk premium built into the curves to be structurally lower, and should be able to bring the rate differential between US and India narrower than what it has necessarily been in the past.
Okay. What's your estimate of the amount of flows that Indian bonds can receive because of index inclusion? There is talk that the Bloomberg Barclays index will also include India soon. So what's the kitty you are looking at?
So, Lata, I think the math on that is relatively straightforward. I think for now we know that the GBI will include India, which should be roughly worth about $25 billion or so of inflows which are to come in. They will be staggered just as the inclusion for the market into the indexes, but ultimately the weight is capped at 10% in GBI. Like you said, the next thing to look for is at what point India gets included in the Bloomberg Barclays Global Aggregate Index. Now, that has its own hurdles in terms of what the index participants require and are looking for India to get included. It's a global bond index. It's got much larger AUM, which is tracking it. It's got much larger market capitalization. India, if it does enter that index, will have a relatively smaller weight compared with in GBI, but potentially much larger flows, because there's a much larger amount of global money which tracks that index. I think a lot of that could probably be towards the end of this year, or only maybe a 2025 issue. But overall, we are at least looking at $25-30 billion potentially in the next fiscal year.
Okay. In that case, where does this leave the rupee? The Reserve Bank has held it in such a tight range, 83 to 83.3 is all that it has moved despite all these vicissitudes. Now will it rise? And the other point that some market guys point out is that the Reserve Bank also has one eye on the CNY rupee exchange rate. So can you also tell me whether the CNY will be allowed to depreciate simply because it looks like China wants to look at the export way out of its current slowdown?
So, Lata, I think the way I look at the rupee, there is, and as you have also actually enunciated, I think there's multiple cross currents here for the rupee. I think on the one hand, one very critical factor will be whether we actually see a more pronounced dollar down cycle happening, which at the moment seems very constrained by the fact the US as an economy is clearly outperforming the rest of at least the developed world. I do think versus emerging market currencies, the dollar will be more influenced by growth considerations than rate cycle considerations. But nonetheless, the dollar seems on, at least for now, a relatively strong footing. For India itself, the currency is not necessarily cheap when you compare it to inflation differentials with India's trading partners or on basic balance front. But on the other hand, we do have potentially better flows coming up ahead, both in terms of whether they do into equity markets at or following the elections, and certainly into fixed income because of the index inclusion issues. I think ultimately the deciding factor would be whether policy permits those flows to come into the market or intermediate it, as to whether is keen on keeping volatility very low or allowing that to translate into better appreciation and gains for the currency. I'm personally biased myself to think that the currency will probably towards the latter part of the year be somewhat stronger than where we are, but I think still very much contained within a range.
No, I must get your view on China. Do you expect that because of this, manufacture your way out of the current problem, China is actually capturing global market shares, even in cars, EVs, lithium batteries, and they're cutting prices. They're seen as a deflationary force. Where is the CNY expected to go? Will it depreciate? And if it depreciates, is there a chance the rupee may depreciate rather than appreciate?
So I think on the renminbi, Lata, one point I would make is, I think what is often misunderstood is that while there is clearly benefits to a weaker currency, especially to one which is quite as much of a manufacturing sector as China is, there are definitely benefits to a weaker currency in terms of gaining more competitiveness, but there are also costs to a weaker currency, and particularly in terms of engendering an expectation cycle, which can actually cause the depreciation to build on itself. And to that extent, for policymakers, there is a very clear cost-benefit analysis there. And they have thus far responded to what has been relatively negative news on the China economy and the China business cycle by pushing back against any of that weakness in the currency. I think ultimately it's a policy choice to make for them, but it's not clear to me that from simply the benefits of gaining more competitiveness necessarily outweigh the cost to them of allowing sharp depreciation in the currency. To take place. So you're right that for the rupee, the renminbi will be an important factor, but I think the cross is no longer at a level which creates a huge amount of concern for the Reserve Bank.
Okay, you don't have a CNY level for range for the year?
So our view is that if anything, if we see a positive momentum build up as you get a positive policy stimulus in China, there is very much a risk that the renminbi actually appreciates up towards 7. So not a very large amount, but a modest appreciation, but very predicated on whether we see the kind of policy stimulus which is required for growth to outperform China in China at around that 5% level.
Thank you very much for joining us, Sameer Goel. So the key takeaways, Indian yields are about to fall to about 6.75, but the rupee may be more ranged and maybe appreciate just a wee bit. That's it on this edition of Indianomics. Thanks much for watching.